Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Luke Rahbari. He is the CEO of Equity Armor Investments. We're going to take a look at why investors need to know where their returns actually come from. Luke, it's great to have you back with us at Market Site. And we're going to take a look at S&P versus QQQ performance. But even though the indexes are competitors, there's a lot of the same components in them.
Exactly. And that's why I wanted to talk about that today. I just want to take a look at 2019 and see where investors or market people got their gains. And I think that's really important because most people that are investors, including myself, you might have several different funds. There might be ETFs, there might be mutual funds, there might be some mixed in. But what you really need to know is where did the market get its gains? And in relation to that, where did your ETFs and the mutual funds you had, or the manager that you had, or the strategies get their gains? And when you start to break it down, it's really hard to see how anybody can add alpha without being in the same stocks.
All right, well, let's take a look at our first chart here,
Sure.
so we can take a look at how the triple Qs performed this year.
Right, so the triple Qs obviously had pretty good performance, but take a look at the biggest stocks in the triple Qs, right? It's all the Microsoft, I think everyone's heard of that. Apple, Amazon, Facebook, Alphabet, C and A, so that's Google, you put it all together, right? Add up those numbers, you're looking at a big percentage of the Nasdaq gain coming from some of the big cap stocks, right? It used to be in the old days, 20 years ago, Nasdaq was up and coming stocks, the smaller stocks that were gaining ground. Look at these things, these are the biggest companies in the world, right? Now, if the Nasdaq's getting its gains from this, depending on the ETF or the mutual fund you have or what your manager's doing, some of them are trying to mimic the Nasdaq. But then some of them have a disproportionate amount of some of these stocks in them. And that's fine if that's your risk profile, right? But you've got to know. So this is why I'm so adamant that if you own an ETF or a mutual fund, look it up on the Nasdaq site or on Google. Everyone's heard of the internet. Look at it. Look at the components they have, because you're going to find that by the bylaws of the ETF or the mutual fund or the style of the manager, a lot of your portfolios are going to have some of the same stocks in them. Right? So you're not diversified.
So you could think you have 5, 6 different funds and they might look identical in terms
But they end up really being 2 funds and you're not diversified at all. And then when that market correction comes or when we have a down day, you're wondering, wait a minute, why is my entire portfolio down so much? I thought I was diversified, but you weren't.
All right, let's move along to our next chart here. We can take a look at the top contributors to the market's 2019 return, and again, it mimics
to the S&P, right? It's the exact same thing. Here's Apple, Microsoft, Facebook, Alphabet, Amazon, right?
Used to be the financials and the energy stocks.
Right,
that would
right. So I mean, this is a really, really important point, right? For 2020, if that's what you want your risk profile to be, I wouldn't recommend it, but if that's what you want, that's fine. Just know what stocks are in your ETF, et cetera. And then if you really want to do some work, if you own 5 or 6 funds or 10 funds, or if you have a private manager doing your investments or run SMAs like we do or have a mutual fund like we do, find out where they're getting their gains and then try to find somebody who's actually going to give you market-like gains without using these stocks. Really adding alpha. Because listen, nobody needs me or anybody else to own Apple, Microsoft, Facebook, and Alphabet, right? Just buy the Qs.
Just buy the Qs, yeah.
Right? That's the biggest theme for 2020. And then you've also got to look at how these indexes are going up and where the gains from these indexes are. So just a really simple example. If Apple was 10% of the Qs, Apple might have been up 300%. Right, just to use big numbers to give that show. That doesn't mean that your manager, if he's got Apple, depending on whether he's got a cap weighted or equal weight or market cap, right, it's going to have a different performance. You also need to know that. So just because it's, for example, 8% of the returns, that doesn't mean that it's 8% of the Qs. The amount that you hold in that, the amount of Apple that you hold, depending on the percentage of how the index is made up, right? That's also important as well. And there's some products out there that have different percentages of these same stocks that say they try to mimic the Qs. You might get outperformance or underperformance. You just have to know. All
right, let's move along to our last chart here, taking a look at the top 10 holdings. And again, looks really similar to what?
Right? So it's starting to look like the S&P and the Qs are really holding a lot of the same stocks. And when more than, and I'm roughly giving these estimates, 50% of the market gains come from 8 stocks and they're both in the same indices, right? It's hard not to believe that a lot of investors are over-invested and they're not diversified in these stocks. You have to know what's in your portfolios, and you have to look for other ways of getting market-type returns, because that's how you're going to benchmark yourself without being so concentrated in these stocks.
Right, and it seems like with the rise of indexing and passive investing, this is just going to continue to go on.
Yeah, and believe me, as hard as it's been going up, it can also come down that hard, right? Be ready for 2020 elections, China, Iran, impeachment, Brexit, which still hasn't happened, the China phase 2, 3, 4, 5, 6, the market's going to be a lot more volatile. Be a little more diversified.
Yeah, I mean, look at the first, what are we, January 9th as we're talking now, a couple, trading sessions into the year, every day it continues to hit all-time highs, considering all of these uncertainties and outliers that are out there.
Yeah, I mean, for our investment theme for 2020 is a bit of a barbell, right? So over here, we want to own dividend-paying stocks, stocks that have good cash flow, that have strong balance sheets, some of these stocks, but they pay dividends. We want to leave the middle alone. And then we want to own some chips, right? Because no matter what happens, I always use this example, nobody's going to send smoke signals anymore. Everyone's going to use phones. If there's going to be a cyber war, it's about chips, it's about technology. Own some of that, leave the middle alone. Some of these other IPOs like Peloton and the number of eyeballs I have, and I'm just going to spend everything I have to just get more eyeballs or more users, and I'll worry about profits later. Let's work for one company, Amazon. Look at everyone else who's tried to do that. WeWork, Smile Direct, etc. Uber, Lyft. It hasn't worked. Leave them alone for now.
Well, you know what? The good side of that is investors are becoming more critical. And they do care what, public investors, they don't want to get left holding the bag, for lack of a better term. So if you want, to find the positive side of that, the silver lining on the cloud, the fact that the investing public is more keen to looking at what the underlying business is versus falling in love with the marketing story, I think that's a positive too.
I couldn't agree more, and I just want to give one last example. There were mutual funds, publicly traded mutual funds, that had IPO shares, pre-IPO shares in their mutual funds, and they were pricing them, right? Including WeWork and some of the other ones. If you didn't know that they had that, you got slammed. WeWork ended up being a $47 billion rounding error, right? From a 40, they were trying to bring it to market at $47 billion, and it's worth zero.
Yeah.
Or somewhere around there, 2, 3 billion, whatever you want to think, right? So you need to know what's in your mutual funds. And also, you're right, the investors have to take a hard look and say, does this thing make sense?
Yeah.
And obviously it didn't.
All right, well, longer term, hopefully we'll be bringing better to the market. Thank you so much, Luke, for joining us as always. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.